All right, everyone. So, as a financial advisor and a financial planner, I get asked a lot of questions on a normal basis. And I was thinking the other day, I think it would be a good idea to obviously I answer these questions and I'll do it on video. So maybe it'll help somebody else out. I get these questions from either in person events when I'm doing any sort of event or any talks that I do or podcasts or whatever. I also get a lot from social media. And I thought it'd be interesting to answer these questions and let you guys know my thoughts on a lot of different topics here. So if you do have any questions, please feel free to leave them in the comments below or shoot me an email and I'll be sure to answer them. And let's get started. Let's get the first question here. Let's see. All right. So the first question comes from Carol, and the question is, George, why does the stock market keep going up when everything else feels expensive and slow? Now, this is a very interesting question, and it's something that we get asked a lot. Sometimes the stock market does not mirror what is actually going on in the economy. There's also a little bit more to that, where a lot of times it feels like the economy is doing much worse than it actually is. And I think that's a time when that we're in right now. I don't have to tell you how divisive the current political climate is. So it seems like depending on what side of the spectrum you're on, it feels like we're living in two different economies. I think as a fake economist that plays one on TV here, I have to look at data and take my biases or the way I'm thinking out of the equation. That's not important the way I feel or the way I think about how things should be, be done. What's important is looking at the data and making those decisions on what's going on. So the important part there is looking at the data, like I said, and the data is not bad. It's not great, but it's also not terrible. We have to look at the hard data and take our opinions and our feelings out of it, and that's when you'll start doing okay. Right now, the market is driven mostly by tech stocks. And that's just the way the world is. Obviously, tech is a huge part of our lives. They make a ton of money, and it is what it is. Whether you like it or not, that's just the way things are. So the important part is to look at the data and take your feelings away from it, and I think you'll do a little better going forward. All right, let's look at the next question from Jay, it looks like. So if the Fed raises or cuts rates, how does that actually change the stock market? Another great question, something that we look at a lot. The actual changing of the rate from the Fed in reality doesn't really affect the stock market per se. And these small changes that they're making, 25 basis points here and there, in reality are not really making huge differences in the stock market. But what we're looking at is a trend, right? The trend is moving towards lower interest rates, which makes it easier for companies to do business. That's pretty much what we're looking at. It can also stimulate the economy because things are cheaper, to buy, in essence. Mortgage rates, even though mortgage rates are not really affected by the Fed rate, the Fed rate is short-term. Mortgage rates are more longer-term rates, and the Fed has no control over that. The market does. But credit cards, for example, your home equity lines of credit, a business that wants to go, expand, it'll be cheaper for them to do so. And in theory, they'll do more of it. And that's what the thought process is. So the Fed has what's called a dual mandate, right? They have to keep employment as good as possible while keeping inflation as low as possible. And the way they affect that, or they try to affect that, is with interest rates. So what the worry is with dropping rates too fast is that inflation is still pretty high. Inflation is 3%. Their target is 2%, which I think that needs to be thrown out the window at this point. 2% just doesn't seem logical, doesn't seem like it's going to happen. So, inflation is a little high. And what the worry is that they lower rates and it's going to kick inflation up again and cause the the inflation that we had before. We don't know if that's going to happen or not. Obviously, this is all theoretics, right? A lot of economics is theory, and then we'll see how it plays out. But that's kind of what the Fed is in limbo on now. All right, next question here is from Lizzie. Can someone explain why interest rates are still this high? Feels like they've been up forever. Okay, so yeah, I mean, interest rates actually have not been high for very long. In 2020, when all the COVID stuff happened, interest rates went down to zero. We actually had negative, pretty much negative interest rates, and they were there for quite some time. And then the Fed kept going up here. So it looks like we are on the downtrend of interest rates. I do think the Fed is going to continue lowering interest rates and seeing how the market reacts and how inflation reacts. Like I mentioned before, inflation is a little bit higher than what the Fed wants at 2%, but I don't think that 2% number is a very doable rate anymore. So let's look at the other question here. This is from Tony. Should I pay off my credit card first or start putting money in my 401k? All right, so this is a very, very important question here, and it's a little bit of both, right? So the reason why I'm saying that is you should be putting money in your 401k, period, end of story, period, full stop. Especially if your company matches the money, pretty much, let's say your company matches 3%. You put in 3%, they'll match it with another 3%. That's pretty much free money, right? You put in, let's say 3% is whatever, $100. If you put in $100, they're putting in $100. So you're doubling your money every single time you put money in there. So 100% you should be putting money in your 401k. On the flip side of that, credit card debt, especially if it's high interest credit card debt, which let's be honest, most of the time it is, you should 100% be paying that down as fast as possible because you're not seeing it, but your money is eroding, right? You're paying interest every single month, and you should be doing so. So I think using whatever 100% of whatever discretionary income you have to allocate to this, I would probably do maybe 70% to paying out your debt, 30% to your 401k. And as soon as that number starts coming down, keep adding to that 401k and continue putting in that 401k. A note on the 401k, my recommendation is always to only put in what the company matches. Do not put any more than that. I'll if somebody asks about it, I'll give my recommendations on why I recommend that. All right, so let's go on to the next one. Sarah has, how much money should I really have in an emergency fund? Everyone says something different. Yeah, another question that I get asked a lot. Usually my recommendation is somewhere between 3 and 6 months. This is going to be dependent on a lot of different situations, how stable your job is. Do you get paid, regular W-2 with a salary? Are you a business owner where, you get some ups and downs? So it's going to be dependent on your situation. It's also dependent on the type of person you are. If you're very conservative in nature with your money, you probably want a little bit more. Most of the time, I see clients that have way too much money in cash, sitting in cash. This is something that we see over and over and over again. And while it feels like a little blankie, or one of those little weighted blankets, you're not doing yourself any favor. That money sitting in your bank account, in your savings account, that's earning 0.25%, 25 basis points, that is not a safe investment. It's safe in the sense that it's never going to go down. But as we spoke about, inflation is high. I believe inflation will continue to stay high. So while you're not seeing it, you're actually losing money every single day with that money sitting in your bank account. So I think 3 to 6 months is a good number. Take a look at your expenses, see how much you need to maintain, 3 to 6 months. Depending on how conservative, how aggressive you are, the more aggressive you are, I would be more in the 3 month range. and then more conservative somewhere in the 6 months range. But anything over that, I think you're doing yourself a disservice. All right, let's look. Brian has a question. How do I even know if I'm saving enough for retirement? I feel behind. All right. So again, something that we hear a lot. And Brian, you're not alone. I think most of the people I talk to, most of my clients feel like they're behind. And this is where my business, the way I operate my business, what I focus on is financial planning. And a financial plan is the perfect, exercise that you should do to make sure that you are saving enough for retirement. Whether you do it with me or do it with whoever your financial advisor is, I would highly, highly, highly recommend getting a financial plan done on yourself. Whether you are 18 or you are 60, the financial plan is the most important thing that you are going to do to make sure that you're on track. So what the financial plan does is it looks at your current savings, your expenses, your income, all that. We run a simulation, what's called a Monte Carlo simulator, and we make sure that you're on track. That's really the only way. And again, listen, the financial plan is not set in stone. There's no guarantees or anything like that, but at least it gives you a baseline and it gives you an estimated guess versus just a complete guess if you're saving or not. Feeling behind again, Brian, this is completely normal. Don't feel bad about that. Everyone, whether they are completely behind or clients that are way ahead, most of them feel like they're not doing enough. So as long as you're saving on a monthly basis, staying within your means, I think you'll be okay. If you want to, talk about doing a financial plan, please let me know. Leave a comment or send me a DM and we can definitely help you out with that. All right. Now we have Matthew. Is it better to buy ETFs or just pick a few good stocks myself? Okay. So there's a lot to unpack here. I think just to answer the question, buying the ETF is the better route. Now let's take a step back. What is an ETF? An ETF, just for all intents and purposes, it's a group of stocks, right? So you can look at, for example, again, this is not I'm not soliciting a sale here, at the SPY, right? So that's the ETF that monitors or that tracks the S&P 500, which is the 500 biggest stocks here in the US. Basically what that does is that you're buying a little bit of a bunch of different companies, And what that does is that it diversifies out your risk, right? So if one company does bad and the others do well, the market should go up like that. The risk you're taking by picking one stock, whatever, insert stock name here, is that you're, in essence, putting all your eggs in one basket, right? Now, with more risk comes more reward, right? If that stock goes up 20%, now you're up 20%. Now, if that stock goes down 20%, you're down 20%. The chance of one stock going down 20% is infinitely greater than, an ETF going down 20%, assuming we're talking about the SPY here. Can they both do it? Yes, 100%. As we saw earlier this year, the S&P was down, a pretty big number, seemingly instantly. So I think for the most part, buying the ETF is the better route, especially if you're not going to work with a financial advisor. If you're just going to do it yourself, just buy, a couple of different ETFs, look around, and, I don't want to make a recommendation because I don't know you, Matthew, and I don't know what your situation is, but buying the ETF is probably the better route. All right, let's jump into the next one. Ellie here. What does it mean to rebalance your investments? I hear that all the time and I have no idea. Okay, cool. So rebalancing, what it is so you have a strategy, you have a portfolio for just to keep this simple, you have 50% of one stock, 50% of another stock. This is a pretty crappy portfolio, but whatever. For this recommended or for this example, we'll use that. Now, what happens is if one of these stocks runs, let's say the stock is up 50%, right? Now, what's going to happen there? We're going to do some, sorry, there's going to be some math here. So that stock is now 75% of your portfolio, right? Because it's up 50%. And the other stock is now 25% of your portfolio, assuming it didn't go up. So what we do in rebalancing is we rebalance. So we sell enough of this stock to be able to bring it down so they're both 50-50 at that point. So what that does is that it kind of, it limits the amount of risk you're taking on one position. And it just kind of, it helps to allocate your portfolio correctly and make sure that we're in line to keep up, to keep whatever it is the strategy that you have. To figure out the strategy, we'd use the financial plan like I had spoken about before, and we make sure that whatever it is, the strategy that you have, that strategy is the one that's going to work best for your particular situation. So great question there. I think we'll stop this one here. I'll continue to answer any more questions. If you have any questions, please leave them in the comments or send me a DM or an email, and I'll make sure to answer them. If you thought this was helpful, please, leave a like, and if you don't mind subscribing, that would be amazing as well. Thank you very much. Have a great day.